Hello again and welcome back to the Perpetual Pip. This is Will Gomez. For our next tutorial, it's time for Trading 101 yet again. It's my pleasure to announce that we're now getting into the actual meat and potatoes, if you will, of technical analysis. You are now taking your first step into making educated market decisions based on the natural behavior that the market exhibits. What we're going to be talking about today is what is a Fibonacci or Elliot wave. This core concept is what's going to help you to understand that ongoing battle that's going on between the bulls and the bears, and better yet, learn when the appropriate striking time is. Let's talk about it. You may have seen this shape before, this spiral shape. This spiral shape is considered to be part of what's known as the Fibonacci ratio or the golden ratio. Okay? Now, first things first, as far as chronology is concerned, scholars in India have been documented as being the first observers of this phenomenon as early as the 6th century. However, the man who has been most credited for this is Leonardo Pisano Bigoglio, okay, or Leonardo Fibonacci, as he's been called. In his 13th century book, Fibonacci, he pretty much popularized the use of of Arabic numbers. So the normal numbers that we tend to use, yeah, he's the guy that made them relevant. Okay? He also, in this book, proposed the idea of the divine ratio, where he discovered that every single number in this sequence is going to be the result of the previous two numbers before it. So, in discovering the sequence, I should say, he also found out that it also works out to a very interesting ratio. Now, I'm not going to get into all the complex mathematics of it, maybe in another video, but as of right now, I want you to understand that this ratio can be found throughout nature. What we're looking at right here on this bottom image, this is a cross-section of the Nautilus shell, okay? And this beautiful pattern, this uniform spiral, it falls perfectly into the Fibonacci ratio. You'll see the same thing on sunflowers, the way rose petals are arranged, pineapples, right? Even something as familiar to you as your face, the position of your eyes relative to your nose, right? The width and the height, and where your mouth is relative to the width of your entire face, etc., etc. We tend to naturally be gravitated to this ratio without even knowing it. As a matter of fact, what is widely accepted, what most modeling agencies, if you will, widely accept as the standard of beauty is this Fibonacci ratio, things that conform more to this ratio. Okay, now for a long time we didn't know that that was the case, but we're just naturally attracted to it. Musical notes, etc., etc. I can go on for days and days and days about it. I'm really crazy about the Fibonacci's. But in any case, what is important though is that the market, which is what we are learning about, tends to also, being a man-made construct, and we are naturally exhibiting this ratio. So since the market is a man-made construct, it also inevitably shows the same phenomenon. In order to better understand this, right? Because when we start talking about numbers and ratios and math, it gets complicated and scary and confusing. So what we're going to do is we're going to take a trip back to the 3rd grade instead. This is what I like to call Neanderthal trading. All right? It's not an offense to anyone. I like to, in martial arts, what we talk about is gross motor skills. When you learn to tackle an opponent, in this case the market, you don't want to learn about the fine, grab the pinky and do this, right? Fine tune. No, you want to know something that you will instinctively do, that it's easy for you to understand, easy for your body to do, because in a fight or flight response, you forget all your fine motor skills. You're not thinking about a symphony, you're thinking about oof, you're grunting, right? So same thing when it comes to the market. We want to learn the gross motor skills that are necessary to be able to react to a market attack. Okay, so we're going to take a trip back to the 3rd grade. We're going to talk about basic physics. Today is my birthday. I've just turned 6, and my mom has just given me a big blue ball for my birthday. So naturally, being a child, being of the generation of children that still played outside, I'm going to go and I'm going to take my ball and I'm going to go play with it outside, right? Now, here's what happens. Would it be fair for me to say that if I bounce the ball off the ground using the same amount of strength, right, that it can predictably bounce to the same general location, right? If I bounce the ball, for every action, there's going to be an equal and opposite reaction. I'm sure you've heard this before. None of this should be scary, right? So, eventually, I get bored of playing outside, so I might come back in the house. Mom doesn't want me playing in the house, but I'm going to do it anyway because I'm 6 and I do what I want until I get yelled at, my butt kicked, right? In any case, so I come back in the house, I find the table, and I bounce the ball off the table. Now, because the ball has expended less energy on the way down, it's got more energy to bounce up that much higher. Everybody following me so far? Nothing strange about this, right? If I throw the ball off of this, it's closer to me than the ground is, so it spends less energy on the way up, bounces up even higher. Eventually, my mom catches me, yells at me for playing in the house, says, "Don't play with the ball in the house, go outside." So I do. I make my way to the backyard, and as it turns out, my parents actually have a swimming pool. It's empty for the winter, and I'm very fortunate in this example, of course. I go to the swimming pool and I decide, you know what, I'm going to bounce my ball in there. So if I toss this ball into the swimming pool, that happens, right? It spends more energy on the way down. If I'm using the same amount of strength, spends more energy on the way down, so it might not be able to make it out of that hole at all. Any of this sound like anything you can't process? Guess what? This is the same basic behavior that the market exhibits, believe it or not. Believe it or not, this is not as complicated as you would think. The market creates these waves, and these waves can, with a reasonable degree of certainty, be tracked and targets predicted. The way that these waves form are as follows. They tend to follow this Fibonacci ratio. So the way that this forms is as follows. The market will, in an uptrend example, the market will start from a low point and make its way to a high point. We'll call that the initial rally, right? The initial push. It's going to move from point A to point B. Now, once it's achieved that move from point A to point B, then it's going to pull back. We'll call this me bouncing the ball, right? So when it moves downward, retraces, it's eventually going to bounce off of something. This is the C point. And once it bounces, based on how deeply it's bounced, we can project with a reasonable degree of certainty where it's going to go. That's going to be the D terminus point. So this is known as an ABCD Fibonacci or Elliot wave. The main difference, I'll tell you right now for future reference, and I'll come back to it when we are actually talking about how to plot these, but the main difference between the regular Fibonacci ABCD pattern and an Elliot pattern is that in the Elliot pattern, they just take the ABCDs one more step and tell you, we expect that there's going to be a reversal after the 5th one. Now, what that means is this. When an ABCD fulfills itself, when this phenomenon is created, then it repeats itself. So once you have successfully tracked a full ABCD wave, your old C is going to become the origin of a new wave. It's going to become a new A. And your old D, well, that's going to become your new B. And so, once again, the market should retrace to a C and extend to a D. And it's going to continue on and on and on until the trend, right? That's how a trend develops, right? A, B, C, D waves. It's going to continue on and on and on until the market decides to break your trend. Reverse. We're going to talk about all of that in future lessons. For right now, this is the phenomenon that occurs, A, B, C, D waves. So when an A, B, C, D creates itself, C becomes a new A, D becomes a new B, and you can continue to track the pattern. The Elliot theory or the Elliot methodology simply says that after about 5 of them, you should expect the market's going to turn around. All right? Pure nuts and bolts. After about 5, the Elliot theory states that the market should turn around. It's not always the case, but it's a pretty solid theory. Right? Now, I understand how the market seems to create these waves. How do I benefit from this? There's a tool, the Fibonacci retracement tool. It looks like this. And this tool is what allows us to track these waves, determine an entry point, a safe exit boundary, and a target, all based on what's known as a retracement extension relationship. Effectively, all you're doing is following the bouncing ball. That's all you're doing. Based on how deeply the market bounces within your AB boundary, you can project what the D target is. Now, there's a lot of numbers going on here. So let's talk about some color coding and getting some familiarity with this. The Fibonacci tool, or retracement tool, right, provides us with retracement and extension values. So you have your A and B boundary, right? This is an uptrend Fibonacci. A downtrend Fibonacci is reversing the opposite direction. We'll talk about this in additional videos. But you have your A-B boundary, and then the market's going to, once it hits the B, it's going to pull back to try to give you a C. So you've got multiple levels that can serve as either resistance or support relative to where your market is. You've got multiple levels that will correspond with a target. There's a lot going on here. The Fibonacci tool is actually, you've got the 236, the 382, the 50, and the 618. These are all color-coded, right? 236 is considered super shallow, and your 382 is considered a shallow retracement, right? Once you get into your 50, 618, 786, 86, all of these are deep retracements. Now, let's talk about what we have going on here. It is standard. It's a standard market procedure to help with the memorization process by color coding these levels. Essentially, if the market retraces to give you your C, if your C forms somewhere in this, touching any one of these red levels, you can expect that the D is going to be at this red level. So if it bounces from red, it's going to red. If it bounces off of blue, if it goes deeper instead, then it's only going to have the energy to make it up to the blue line, or the 1.27. If it comes down deeper still to the 8.6, again, it's spent more energy on the way down. It's not going to have as much energy to go back up. So red to red, blue to blue, green to green. If this color scheme doesn't work for you, again, it's on most charting softwares, you'll be able to color code this to whatever pattern you like. This is just a pattern that I'm used to seeing. But you can realistically color code it to whatever you like. Just remember the following numbers. Your 236, 382, 50, and 618 all correspond to the 1.618 projected D extension. If it's the 786, then it corresponds to the 1.27. And if it's the 86, it corresponds to the 1.18. Nice and easy. All right? Now, as far as these numbers, where are we getting these numbers from? This is all based on the A-B boundary, right? If the market retraces to touch the 50, this is quite literally, this is a percentage of the total AB. So this is just standard length. If the market comes down to touch the 50, it's literally halfway down, 50%, right? 0.618, or approximately 62%. Approximately 79%. If it comes all the way down to touch the A, that's 100% retracement. Right? So you have your retracement lines. Furthermore, if you're ever wondering, okay, well, I'm looking at this, and we'll get into more detail when we actually look to plot this out on a chart. But if you are ever wondering, well, wait a minute, what actually qualifies it? The Fibonacci actually reveals to you price points. Next to the percentage, it will tell you an exact price point that will qualify that market as being that level of retracement, right? So this tool is a phenomenal thing to be able to use with the market, because all of a sudden, all the insanity that you think is going on becomes very organized. It is still chaos, but it's organized chaos now that you understand how to read it. This has been our lesson on what a Fibonacci or Elliot wave is. I hope that you've enjoyed what you've learned so far. If you did, please feel free to give us a like and a subscribe. And if you want, join us on the actual perpetualpip.com website. In the tutorial section under Learn How to Trade, this information is available also completely free. And once you've learned enough, or if you feel like you want to try to actually trade live, if you're an experienced trader for that matter, and you want to join us in the live trading room, also feel free to come on in. I broadcast during the European sessions, 2:30 to 5:30 a.m. Eastern time for now. Future plans to expand to the rest of the market sessions, but for right now, just the active zone. Hopefully you'll join us at perpetualpip.com. Coming up next, how to plot a Fibonacci or Elliot wave. This has been Will Gomez. I'll see you in our next video.